All right, welcome guys. It's Nick with MarketMakersMethod.com, and I'm here to bring you quite an introduction, just so we have all the basic concepts, all kind of marked down, just so we understand before we actually get into all the curriculum in this course. So in this lesson, we're going to be covering everything from pips. So what is a pip? How do I calculate pips? How do I calculate them on my MT4 platform? And this is going to be very important just because you need to understand, your risk management and then your lot sizes and how much each pip is worth and etc. We're going to go over brokers, some of the best brokers for your US clients, also for clients that are in the US that want more leverage. If you guys are outside of the US, then you guys can really go with any broker because there's really no regulations as we see in the US. Order types, we're going to go over order types and lot sizes, okay? So without further ado, let's get right into this lesson. So what in the world is a pip? Okay, so we always see pips. You can call them points. So basically, a pip is basically a unit of measurement to express the change in value between two currencies. Okay, so every time, say right here, we have the Euro USD, okay, which was one of the most traded pair in the Forex market. When we see the price change on the fourth decimal, on the fourth number, basically that's going to be one pip. So from 1050 to 1051, that is one pip. Okay, so a rise in value on the fourth decimal point for the US dollar is going to be one pip. And I'll show you exactly how to really easily just calculate your pips on the MT4 platform after this. So a pip is usually the last decimal place of a price quote. Now, this isn't always the case because on the USD Japanese yen pairs, basically one pip would be the second value. Okay, so they go out two decimal places only. This is only for the yen pairs. Okay, so as you can see, Euro USD would be the fourth decimal point right here, and then we have, make sure I have the pointer, get rid of this little box that always pops up here. Okay, 1 second, whoops. All right, let me get rid of my pointer here. Here. Okay, so let's continue now. So basically, to show you better, this is the pound US dollar. So this is going to be a one pip move to the upside. So price went from 1.3536 to 1.3537. So as you can see, this right here is a one pip increase because it is a USD pair. So it would be the fourth decimal point, as you can see, as seen in our last slide. So this is going to be a little bit easier for you to construct in terms of understanding the pips. So the fifth decimal point, this is most likely Euro USD right here. It is in fact Euro USD. So this is going to be called a pipette. So don't really pay attention too much to this, but this is going to be basically a point one, so a tenth of a pip. So you need 10 of these. So you need this to go from 2 plus 10 to make it one pip, okay? But we'll just focus on the main concept. So each one of these is going to be one pip right here, right? So this is 8 pips, of course. So if this goes from 8 to 9, that's one pip. If this goes from 3 to 4, that's going to be 100 pips. Okay, so hopefully that makes sense. Sorry about that. My bad. So if this goes from 3 to 4, that's going to be 10 pips. Okay, so my bad. And then this right here, if this goes from 5 to 6, that's 100 pips. And then if this goes from 1 to 2, that's 1,000 pips. Okay, so you have the illustrations right there. And right here, don't need to really worry about this. You're not going to really see this moving much at all, even on the monthly time frame. So what is a lot? Okay, so now that we've covered pips, which I'm going to show you how to calculate them, now we're basically going to be talking about what a lot is. Okay, so in the past, spot Forex was only traded in specific amounts called lots. Okay, and this is basically the number of currency units you will buy or sell. So a standard size for a lot, right? One standard lot, if you've heard the word one standard, you know, it's going to be 100,000 units of a currency. Okay, so don't get overwhelmed now if you don't understand this. We'll get right to the numbers. So there's also mini lots, micro lots, and nano lots, which we don't really focus on nano lots at all. It's really just going to be mini and micro. And those would be, for the mini lot, would be a 10,000, which would be a tenth of a standard lot. Then we have 1,000 units micro, and then 100 units for nano. So what do I mean by this? Okay, so let's assume that we'll be using 100,000 unit, right? One standard lot size. So we will now recalculate some examples to see how it affects the pip value. So this right here would be your mathematical formula for understanding the pip value. And not all pip values are the same. The Swiss franc pairs actually pay the less, and gold and Japanese gold and pound pairs are going to actually pay the most. So as you can see here, we would do, so let's say the exchange rate is 119.80, right? What we would do is, okay, so we'd take our 0.01, divide that by 119.80, times it by a standard lot, right? If we're using a standard lot. And then that would come out to be $8.34 per pip. Now the same would apply for the USD Swiss franc, which would be $6.87 per pip based off of the mathematical formula that we have here. Okay, so in cases where the US dollar is not quoted first, the formula is slightly different. So it's going to be a little bit different, as you can see. So let's say the exchange rate was 119.30, and don't worry, guys, this is just for you, for you kind of like numbers people that really want to understand the numbers. But I'm going to show you guys a more simple way that you don't really need to do any type of math at all, because once again, we're here to understand the strategy and not learn math. That was back in your school days. Once you're a mathematician, of course. Anyways, let's get back to it. Okay, so 119.30, right? That's the exchange rate for for EU. Okay, so we're gonna do 0.001, right? This, because this is a 1 pip, right? This represents 1 pip, right? Remember that, the fourth decimal point. So that's why we're multiplying that by the current exchange rate, and we're gonna multiply that by 100,000. Because that's 1 standard. We're trying to calculate what 1 standard is for 1 pip move. Does that make sense? So it's going to equal 8.38 times the exchange rate again, which is going to give us about $9.99, round that up to around $10 per pip on Euro USD. Same thing applies for cable, which is the pound USD. Okay, so now here's a better representation of what we're looking at. So this is going to be 1 standard lot, which is going to be 100,000 units of currency. We have a mini lot, which is going to be, so then we have a mini lot right here, which is going to be 10,000 units of currency. So a mini lot is going to be 1 pip. A standard lot is going to be $10 a pip, right? A micro lot right here, 0.01, which is going to be 1,000 units of currency, is going to be 10 cents a pip. And a nano lot, which is only going to be 100 units of currency, 0.001. Now, many brokers won't even allow you to take nano lots. is going to be 1 cent per pip. So you need 100 pips just to make $1, which is just crazy. Usually I tell my students to start out with trading micro lots here, which is a lot more, which is a lot easier to kind of start out with. So I hope this representation kind of helps you out. Standard lot, which is going to be $10 a pip. Mini lot, $1 a pip. Micro lot, 10 cents a pip. And nano lot, 1 cent a pip. And of course, for different currency pairs, that range could be a little bit off, as in for the yen, USD yen is going to be about $8 a pip instead of $10 a pip. Okay, so all that is clear. So now we're going to tackle into leverage. Let me actually clear this all off the board. Leverage. So you are probably wondering how a small investor like yourself can trade such large amounts, right? Because 100,000 units of a currency, I don't have $100,000 in my trading account. I don't have that type of balance. How can I buy a standard lot? Well, this is what we have: leverage. Okay, now leverage is basically, so think of your broker as a bank who basically fronts you $100,000 to buy currencies, right? So all the bank asks you is to deposit $1,000 as good faith deposit, which is not a fee, it's just being deposited as margin. So what is margin? So margin is basically the amount that they ask you to deposit in order for them to borrow you the $100,000 to buy a standard lot. Okay? Well, sounds too good to be true? Well, no. Leverage is one of the reasons why the Forex market is so popular, and why it's more popular than trading stocks. In terms of stocks, it can, legally in America, only do 1 to 2 leverage, from what I know from my experience of trading stocks. So, okay, so for example, if the leverage is 100 to 1, or 1% of position required, right, and you wanted to trade a position that's worth $100,000, which is 1 standard lot, like we talked about, right? But you only have $5,000 in your account. Okay, well, no problem. Okay, as your broker would set aside $1,000 as a deposit and let you borrow the rest. So, okay, so look at this in better terms. So basically, what we're looking at here is going to be, if this is 100 to 1, or 1% of the position required, so you would only need 1% of $100,000 to take on a $100,000 position. So you would only need $1,000 to control $100,000 worth of a currency. So that means that you have 100 times the buying power. So if you have $1,000 account, that's basically perfect amount to buy 100,000 units. But of course, then you would have no balance to comprehend any negatives. So that would basically margin you out and lose your money instantly. Then, of course, any losses or gains will be deducted or added to the remaining cash balance in your account. That's what I mean by, so let's say all these conditions apply to your account, right? Let's actually say, this would actually be a perfect example, right? Because if you have $5,000 in your account, then basically all you would need to put down is $1,000, right? $1,000 times, right? Times, so $1,000. So okay, so $1,000 right here times this 100 right here, right? Times the leverage, which is 100, is going to equal, right, 100,000, which is going to be 1 standard lot right here. Then what you would have remaining, right, that's the deposit. What you would have remaining is $4,000. This is going to be your cash balance, where now with your position, if you are in, say, 20 pips in profit, which would be about $200, then this 4,000 would then be floating at $4,200. Vice versa, if you're losing $200, then your account balance would then be $3,800 floating with that new position. Okay, so hopefully all this makes perfect sense. Let's move right along. Now we're going to get into order types. Okay, so right, we've heard there's different order types. There's stop losses, there's buy stops, there's sell limits, there's execute market orders. So let's straighten all that out right now. Okay, so a market order is usually the entry that I focus on the most because it's the very simplest order out there. It's basically you're basically buying or selling at the best available price. So if you want to buy right now the Euro USD, you click buy and you buy instantly, or you sell and you click sell, you sell that pair instantly. So you basically click buy and your trading platform would instantly execute a buy order at that exact price. Okay, so that's very straightforward, very easy to understand. You're going to be using this order most of the time. Now for a limit entry order, so a limit entry order is placed to either buy below the market. So what you're going to do right here, so let's say this blue dot right here is where current price is. Okay, price is currently at this blue dot. But you think that price is going to spike down, say you like, okay, it's going to do a stop hunt low. So you're going to say it's going to do a stop hunt low 25 pips down. So you're going to already have a limit, a buy limit placed right here so that when price reaches here, it'll automatically get you in the market for a buy. And based off of, you know, how you created the order, you're going to have the stop loss and the take profits already set in that order. So very, very useful if you're projecting the stop hunts low, stop hunt high, and also very useful if you're not going to be in front of your computer and you want to get in to the order. Now a sell limit is the exact opposite. A sell limit is your basically this blue dot, you're currently at this price level and you expect them to say stop hunt high and drop. You say, okay, I think they're going to stop hunt 25 pips above where current price is. You set a sell limit here. If they come to that price, it'll get triggered and you're in the market for a sell. Okay, so hopefully all that helps out with the visuals as well. Now, a stop entry order. Okay, so let's move this. Okay, so a stop entry order. All right, so this is our this is going to be basically the opposite of the limit. All right, of the limit order entries. So what this is a stop entry order is an order placed to buy above the market. So if you're right here, right, if this right here is current price and you expect it to continue rising and you expect the bullish cycle to continue, simply all you're going to do is you're going to buy stop right here at this green line, and simply when price comes up to it, it's going to enter you in the market, and then if it continues going up, your position is in profit. Same thing for the sell stop. It's going to be you're right here, this is your current price for the sell stop, and you're saying, okay, I believe that there's going to be another level of drop in this bearish cycle. So what I'm going to do is I'm going to place a sell stop right here. And when price comes down here, it's going to get me in the market. And as it continues dropping, it's going to have me in profit. because I was right with my prediction with the levels of drop, because I trade market maker's method and I understand this stuff. All right. I just had to say that. All right. Let me clear these drawings now here. There we go. So moving right along, stop loss orders. So a stop loss order is a type of order linked to a trade for the purpose of preventing additional losses if the price goes against you. If the price goes against you. Why am I repeating this? Because please never trade without a stop loss. I don't care if you're George Soros or Paul Tudor Jones or Ken Griffin or some of the best hedge fund managers to live. Don't trade without a stop loss. Okay, so a stop loss is basically if you're entering in to a trade. Let me annotate this for you. Right, if current market price is right here. Let's say this is current market price, and you're looking to enter in a buy right here. Okay, so you entered in, boom, you entered in a buy. Let's green, you entered in a buy right here. Okay, you entered in a buy right here, and your stop loss, let's make the stop loss yellow for this sake. So, okay, so you entered in to, and the price will be black. So you entered into a buy right here, and okay, price is kind of, all right, awesome, I'm in profits. Then we had a nice bearish candle. Boom. You think it's gonna go up, and then boom, they spike down, and you're in the wrong direction because you bought right here. But the market, with their stop loss order, the stop loss would have gotten you out right here to prevent any further losses if this price continued tanking to the downside. So it's very, very important that you protect your equity this way with a stop loss, and vice versa. What we can do is if price decided, for instance, say price decided and it kept on rising, what you can do is you can then place your stop loss here in profit and secure equity just in case price reverses. This stop loss that you placed here in profit would have gotten you out right there, and you would have still made a profit regardless of where price falls. Okay, so now you can understand just how important a stop loss is. And I'm pretty sure I can have my buddy over here tell you more about the importance of a stop loss. This koala bear. Okay. So, all right, so I'm going to get into brokers now. 5 best Forex brokers accepting U.S. clients. Well, so from my experience right here, from my experience, I know Forex.com very well. They are a solid broker for U.S. clients if you want a very heavily regulated Forex broker. I use Oanda as well. They are very good, very heavily regulated in the U.S., and they're good. Interactive Brokers is also a good broker, but then these two, I don't know about them. I know Ameritrade is popular with stock options and trading equities, but for Forex, I don't know. And what we're looking for is a broker that uses the MetaTrader 4 platform, because that's the platform that I'm going to provide you, right, that I already provided you with all the indicators and templates so you can get going and trade with my template, right? It's only for the MetaTrader 4 platforms. So choose Forex.com or Rwanda for the US clients. Now, if you're non-US, there's a few other brokers, or if you're non-US, you can go with almost any broker you want that has MetaTrader 4 that's regulated, because you guys aren't US citizens, meaning that you don't abide by these by these heavy regulations in the US. Okay, so higher leverage for US traders. These are good brokers to start out with. Now remember this, guys. If these brokers give you high leverage, I'm pretty sure that LMFX provides you with 1,000 to 1 leverage, and Trader's Way is the same. This is going to mean that Trader's Way is not regulated at all. But for US clients, it's good if you want this leverage. LMFX, I believe, is not regulated as well. I think they have some sort of regulation. Last time I checked, they didn't, but I think they do now. But they do still accept US clients, and they offer you 1,000 leverage, because for US traders, the maximum of leverage that you're going to get legally in the US is only 50. So imagine this. If you have a $1,000 account, you only have $50,000 of buying power, meaning that you can only buy 5 mini lots. But then you have no cash left over. So in reality, if you only have $1,000 and you have 50 leverage, you're only going to be able to really take 1 mini lot, which is just going to control 10,000 units, which is going to be about $1 per pip. Okay? Hopefully all of you guys followed along with that. Now you can always do your own research on brokers as well, which I do recommend, which is obviously the best way to stay up to date with all the laws and regulations, because there's always some type of new broker that's always coming into the market. Some brokers are getting busted, such as FXCM, which they got busted for trading against their clients. That was a headache for me as well. Okay, so believe this is okay. So all right, guys. So here I'm going to show you. Here's our MT4 platform. I'm going to show you exactly how to calculate your lot sizes. Calculate your pips, and then how to kind of maneuver through the platform and be able to take positions and see everything for yourself. So what we're going to start out with is our pip calculation. So this right here is Euro USD on the 15-minute time frame. We're simply going to head over right here, and we're going to click on this crosshair right here, okay? So we're going to click on the crosshair, and now we have this crosshair here. So if we want to calculate, say we got here, this is our Asian session, here's our stop hunt high. We get in off of this pin bar that's right here for our 3 hits to the high. What we want to do is we want to then click and hold and move the price to wherever we want to calculate the pips. Let's say right here. Notice that it says 253. So it's not 253 pips. What we do is we take off the last value, and we only calculate the first two numbers. So this is only 25 pips. Okay? Are you following along? Only 25 pips. Now, if we come here and we go more down, this is 32 pips. This is 42 pips. That's 51 pips. And that's 57 pips. Okay, so that's how we calculate the pips on Euro USD. Let me show you on GU. The pips are a little bit more. So if we got in at this pin bar here, right, coming here, that's already 48 pips, 49 pips, 80 pips, 112 pips, right? We take off the last value. That's 127 pips. That's 144 pips. Okay, so that's kind of how you exactly calculate how many pips you're getting. And then, of course, for your orders, you click on New Order right here. And this is going to allow you to select the volume, right? If you're taking, say, 0.1, which is going to be a mini lot, which is going to be about $10, which is going to be about $1 a pip on pound USD. And if you simply click buy by market, that's basically a market order. That means you're going to buy instantly right now at this current price. For the sell is the same thing. You're going to sell right now instantly. Now, if we drop this down to type, we're going to do a pending order. And this is where we're going to choose from either a buy limit, sell limit, buy stop, or sell stop, right? And then you can place in where you want your stop loss to be, your take profits, and at which price you want this buy limit to be placed at. And if you want any type of expiry, say if price doesn't reach your level in 2 hours, you can have it set to expire so that it's no longer activated. Okay, so hopefully that helps. So that's going to wrap it up for this lesson. We went over pips, brokers, order types, and leverage. So we're going to kind of dive more into trading psychology and risk management as well, just to cover all the fundamental things that you must know as a trader before you even learn a strategy. Before you even learn any strategy, you must understand the fundamentals to stay in the game and treat trading like a business and not a hobby. Okay? All right, guys, it's Nick with MarketMakersMethod.com, and I hope to see you in the next lesson. Thanks. Bye.